I am Deb Cohen, and I am here with the Tunador team, Samantha and Ton, who are work for Atlantic Coast Mortgage, and they are mortgage lenders. And it is National Mortgage Professional Month in September, and so they have so generously agreed to sit down with me and answer some questions that I think a lot of people are asking right now about mortgages, about the real estate market. So my friends, clients are saying the following very frequently. Interest rates are so high. Oh, they're outrageous. I can't afford to buy anything. I'm going to sit out for a while. I just, they're too high. I'm not going to do anything. What would your response to that be? Because there are people out there who are buying homes. So what's your response to that concern that interest rates are too high right now?
Can you go ask your parents what their first interest rate was?
Can you fix it? 1972, what would a mortgage rate have been?
I don't know, 72. It was probably similar to where we are right now. Okay. It's that 81 time frame that was insane when we were talking 16, 18% the 1 year average.
Okay.
If anybody's really curious, you can go, Freddie Mac keeps a historical survey that goes back 30 plus years, and it'll show you, there are always going to be ups and downs, which is, gets into the whole thing that agents talk about, or many of us professionals talk about is, buy real estate, the house is your house, it's permanent. The mortgage isn't necessarily so. Right. So, yes, the rates today are higher than what people got used to the last few years. They're not the highest we've seen in our careers by any means. They're not the highest that we say our parents have seen. If you ask anybody over 65, let's say, they've seen 12, 14, 16, 18% rates. So seeing rates in the 6-7% range is not crazy at all. And there will be opportunities to refinance. We don't know if it's 6 months from now or a year from now, but it will happen. So they're going to go up and down. I would say focus on the house. That's the most important thing.
I personally feel like the rates are kind of normal, and if anything, a lower rate is almost irresponsible. And I think it's going to take a little bit of time to get used to it, but we can't control the rate. Nobody here can control the rate, and none of us know what's really going to happen. And I think about it from, if I need to and or want to move, I can lock in today and know what today's rate is. I really think it's more likely to go up. Right? So if you wait and rates go up, you lost out on what you could have had, and you'll have regret. So lock in on today's rate and today's price where you know what it is, because we do know that if the rates go down, prices are really likely to go up. Experts are saying 10 to 15% increases. We were reading in Fortune, and Barbara Corcoran was, we all know there'll be a race because there is a high demand, there's a need for housing. So if you lock in on today's rate, you know where you are. If the rate goes up, you'll be so pleased you locked. If the rate stays the same, great, you know what you have. If it goes down, you refinance. But likely, if you're waiting the market, you're gonna lose because it could go up, and prices will definitely go up.
And I like what you said too about buying a house, and I know, Sam, that you are someone who's very interested in the science of happiness, as I am too. And so I just feel like I hate to see people who are putting off an important life step or an important life chapter because of the interest rates.
Yeah, I think to increase affordability, you buy a smaller home, or you buy a little further out, or you add an extra income, right? I mean, there are times when people have worked 2 or 3 jobs. Or you house hack, you rent out a room. It's it used to be very normal to have a roommate. Now it's not so normal. So there are ways to increase affordability that you can control.
And so purchasing in this area for some people is going to be a stretch at times. And that's a tough pill to swallow, especially younger people first getting into the market. And I go back to 20 some years ago when we bought this house, and I tell the story frequently to young buyers. We had a hard line in the sand as to a sales price. Hard line in the sand. I was not going over that. And we found the house that we've been in for 23 years, and it was $5,000 over. I was not going to go there. This one talked me into it, and she said, and this is true, she said, in 5 years you're going to be laughing at yourself. And that's the truth.
Yeah.
So a lot of times, there may be some discomfort up front, but time will heal. I mean, it will turn around where Yeah, so try not to focus on the little things, and I'm not saying that mortgages are is a little thing, but when we're talking about whether it's $50 or $100 or $150 a month, think about what's more important in the next year, 2, 3, 5, 10 years.
Right. I talked to someone yesterday who bought her first home. Her parents were like, "No, this is terrifying." It was, in a questionable area, and what ended up happening is she did go forward, and because it was an area that had a big opportunity to improve and just simply doing some cosmetic work, she ended up with a ton of equity when she went to sell that home. It was just a stepping stone. It was not her dream home. And sometimes, it can be a short dream. It can be just I just feel like you have to get started. And I think about these young adults now who, maybe their parents are the ones who are scared of the price or the location, but getting that opportunity to get started and spending money on a home and just kind of shifting, I don't want my kids spending $600 or $1,500 on front row tickets to a concert, right? I want them having such a good dance party, standing on their countertops in their kitchen that they're proud of in their home, because I want them to protect their future. I want them to spend their money in a way that will benefit them long term. And our homes, think about years ago, location was how close you were to the city. Now location is about your lifestyle. And you have so much more flexibility. You can live within 3 hours of the city where you work, because you only have to go there once a month or twice a month, right?
Yeah,
so
definitely.
you have some opportunities to increase affordability by changing your location now.
That's great advice. So, of course, we're all familiar, and many people are familiar with a typical conventional mortgage, which has people putting 20% down and then having a fixed interest rate for 30 years. And I think that, I don't even know how common that is, but I think that's the type of mortgage that most people are familiar with, and I think that scares people. One, because 20% down seems like a lot of money, and sometimes money that people don't have saved, or it's going to deplete their savings if they go forward with a purchase. And then fixing an interest rate for 30 years if they kind of feel like it's high. So can you talk about what other kinds of mortgages there are besides that one that so many people know about?
Let's just start with down payment. I mean, people do think that. Actually, I was, before you were, right when you walked into the house, I was upstairs sending an email back to a client that had reached out, and actually it's a young couple. It's not their first home, it'll be their second. Their father's a realtor, and they were like, "Well, we don't have the 20% down, but we have 15." And I'm just, so my question back was, what's your goal as far as how much do you want to invest? But I don't know yet their full financial picture, because I cringe when I see someone thinking I've got to put 20% down and it's every penny they have. I cringe when I see that. That's when I pull out let's look at 5%, 10%, maybe 3% if it's a first time buyer. Certain instances it could be zero down. I think it's wiser to keep your cash invested, put as little down on the house, and let that 5%, 10% grow your equity. Leverage your investment that way. So as far as down payments go, I mean, depending on the buyer, depending on the type of loan, could be as little as zero down, 3% down, 5, 10, 15 are common scenarios for conventional loans. All the conventional means it's not a government loan. When we start talking government loans, VA loans, zero down, FHA loans, which is a great product, it's kind of made a resurgence this year. Some of the fees were dropped, much more attractive. It's 3.5% down. So I would look at those. There are, of course, opportunities to buy the rate down. People talk about that, paying points.
Can you explain what that means?
So for most loan programs, there's never going to be just one interest rate. Like I also cringe when
What's rate?
What's your rate today, or what's the rate for this? And I'm like, well, it depends.
You should see the spreadsheet.
For most programs, there's going to be not one interest rate. It's going to be a range of rates. It might be 10, it might be 15, it might be 20 different interest rates. And there's typically the par rate, which has no cost, no points, no discount points, no charge. And that's usually what you see advertised or cited or quoted. Not always. It depends on different companies' marketing plans. But there's going to be a rate that's the par rate that doesn't have a charge. And then frequently there are rates that are higher that have a credit associated with them, and rates that are lower that have a charge. And so the charge for lower interest rates are measured in percentage of the loan amount. where, and then you hear points, discount points. 1 point is 1% of the loan amount. So if you have a $100,000 loan, 1 point is $1,000.
Okay.
Half a point is $500. And that's points for the lower rate tiers. If you go to the higher rates, that's where there's a credit. So it's called a lender credit, same measuring, 1% is, 1% of the loan amount is 1 point. Lender credit, where you're getting a slightly higher rate for the lender to pay some of your closing costs. And that's something that you don't use too often, but sometimes in first-time buyer scenarios where we're doing a zero-down loan, if someone really is scraping cash to get in, in that case, I'd say, yeah, then it could be worthwhile.
Well, and I think people hear discount points and they think it's a savings. It's not. Like if a lender's saying we have discount points, they're not giving you a discount, right? It is simply upfront
It's
money
a
to
charge.
buy your
It's
rate down.
prepaid interest
And-
is what it essentially is.
And that's where we'll start asking questions like, well, how long are you going to be in the home? How much of a risk taker are you? When do you think you'll be able to refi? Because we don't know. And you would want to get closer to 0 points.
For most people, that's what makes the most sense. Yes.
You would do more points if you think you are going to stay with that rate for a long time. And there could be some other variables. But generally, we're looking at it and asking them questions to help guide them based on their ability to repay, also where their comfort is on the payment, and how long they think they'll be in the home or how long they think they would have that rate. We had somebody recently who wanted a higher rate and a higher write-off for a tax savings. So don't just assume people want the lower rate. He was like, give me the highest you can, right? So it's rare.
It
is a consideration.
Some of me people ask that question, but
I was shocked when I read it. I'm like, am I reading this correctly? But people do have different needs there. And then you can take, for more creative financing, you could look at like a buy down or an ARM product, which might help with the overall affordability and reduce the
an
payment
ARM
shock.
is an adjustable rate
Yeah, and
mortgage.
can you explain that? Because I've heard a lot of people talking about ARMs right now.
Yeah,
in this
ARMs
environment.
aren't quite back yet.
Okay.
They're edging that way.
They're
So
edging
ARM
that
is
way.
adjustable rate mortgage.
Yeah, it's really it's been a good 10 years that we've seen ARMs be really prolific in the marketplace.
Okay.
But it's where the interest rate starts at a lower rate,
Okay.
and then it can adjust with the market. And the more recent adjustable rates are going to have a fixed term up front. So when you hear somebody talk about a 5-year ARM or a 7-year ARM or a 10-year ARM, that means it's fixed for 5 years, then it can adjust. Fixed for 7, then it can adjust. And there are multiple different types of them out there. And that's also, again, Samantha was just saying about how long will you be in the home? That's a big question. So if someone's like, well, this is I'm stationed in DC for 2-3 years, that might be something to look at. Pricing isn't quite there right now. Probably we'll see that come back again soon. Many people are predicting that in the next year to 2, we'll see them be more prevalent. But they do exist, again, depending on price point and down payment amount and all that.
I wouldn't be scared of them. I would look at them, and what I love with the way we run numbers is we can show people, if you choose this product, this is your savings immediately, monthly, here it is 5 years, 10 years. We can show them where the payment would go, worst case scenario, best case scenario. So we really walk through helping them navigate and understand it. You're definitely, from an educational standpoint, not only just throw a spreadsheet at them, but you walk them through with a video tour of their options. And in the end, you're able to say, do you have any questions? And they're like, no, I've never seen anything so thorough.
Well,
This is amazing.
I like the program that we use, which Samantha's talking about, is it tells us, what everybody wants to know right now is what's my rate, what's my payment, what's my cash to close, but it also looks in the future, and I use a default 5-year and 15-year snapshot. So it's a snapshot in time of if you make regular payments, meaning you don't pay extra, pay your balance down, this is what you'll, in 5 years, this is what your loan balance will be, and we can look at different options to see which one makes the most sense if you're going to be in the house for 2 or 3 years, or 5 years, or 10 years, or 15 years. And you can calculate the cost that way. So I always call it a snapshot in time, snapshot in the future.
I think generally, when you're looking at getting into the home and you're considering your down payment, typically the numbers will work out better for you financially. If you're looking at your net worth and long term, if you put less down, right? Let's say you could pay cash for a home. You'd put 100% cash into the home, paid for, which is nice. There's no payment. There's just the taxes, insurance type thing. versus if you can get into a $500,000 house for $5,000, you get put $25,000 into the house is growing on the full value, and your other $475,000 could be invested and growing, right? So I think a money manager would typically say diversify and put as little as down on the house.
Well, that's leveraging your money. So let's say it's a $500,000 house and it's a $25,000 down payment, and you do have the wherewithal to pay cash. Do you want that extra $475 sitting in the bank, not doing anything? Do you want it sitting in the house earning equity, or do you want to invest it in earn what's S&P's average over the last 10, 15 years?
9%, I think.
Almost 10%. So would you rather earn 10% on your money, pay 7% mortgage, or
Yes,
Right.
yes, you always earn higher, pay lower, for sure. So yeah, it's been interesting to see the differences there. Like recently we've heard people pulling money out of a 401k to buy their house because they needed cash. It's like, is that necessarily the best option? Right?
That's scary.
That's
when I really
scary.
cringe is when
or they're pulling equity out of another property, then they're paying a higher rate for that money that they're buying a house with. Borrowing at 7% plus or minus is really cheap money. Like
It is,
we go put money on credit cards.
9 to 10% in the market.
Yes. I think we just need a little mind shift change there. And just general affordability has to be shifted in other ways because we can't control the rate, and there's not enough inventory for us to bring prices down. We really don't want prices to come down on homes either, right? As an industry. So yes, they can start building more homes, but that's not a quick fix. So affordability has to be fixed in other ways.
Yeah. But one of the things I love about what you said is that you will really sit with somebody and allow them to make an apples to apples comparison about different products on parameters that are important to them. So that's really valuable.
Right, for some people it's going to be the payment. For other people it's going to be the cash to close. For other people it's going to be how long they're going to be in the home.
Right.
I mean, there are going to be different variables for everyone.
Yeah. So thank you for demystifying that. I think it's really helpful because I think people see what appears to be a high interest rate. Really, it's relative to this unusually low interest rate that interest rates that we've just experienced over the last couple of years. Okay, so if somebody thinks that they want to buy in the next year, when should they get together with you? Was it too early to be talking about?
Always preliminary.
Yeah.
Sometimes people say, this is just preliminary. We're like, we know, because we don't know when you're going to get a home. And I think between a combination of like our soft pull and the kind of the financial guidance, I think the sooner the better, because you never know when the right home is going to come up, right?
100%. So that's one of the, and this is not standard for every mortgage company, but what we do at Atlantic Coast is we do a soft credit pull, so that kind of eases people's fear of getting their credit pulled.
Can you just define soft credit pull?
So a soft credit pull versus a hard credit pull, a soft credit pull is not recorded with the bureaus.
Okay.
We do get the same information, so we get credit scores, we get liabilities, and any information from the credit bureaus we will get with a soft pull, and we can run our systems that we need to give a pre-approval. It's automated underwriting. It's the same thing as a hard pull, except it's not recorded. A hard pull is recorded, and that's where people get afraid of, you pull my credit, it's going to ding my credit. Well, it isn't a derogatory, it's not a ding, but it could move, a hard credit pull could move someone's score 2 to 5 points in the short term. It's not a derogatory, so it's nothing permanent. And if somebody has very good credit, it's really nothing to worry about. If someone's credit's on the lower side, then yes, they don't want too many hard pulls in a short amount of time, because the credit bureaus then look at it. If somebody's applying for a lot of credit lines, especially when you get into car loans and credit cards, that could be considered a negative. Well, our pre-approval is with a soft credit pull, so it's not recorded, it's not a ding, it doesn't impact credit score at all. So if somebody says, hey, I'm not looking to buy till next summer, but I want to plan, come on, let's do an application now. That way, instead of giving you estimates or initial estimates or rough estimates, I can say to you, okay, based on today's real estate prices, today's interest rates, this is the kind of mortgage that you will get approved for. So we can give good information, and we can also use that to help with credit planning if someone needs it.
It's harder when somebody comes in on Saturday afternoon saying contracts are due tomorrow and they're not prepared. Because we actually do that in-depth part of doing the pre-approval for them. We can't just go on a quoted income and some basic information, because we have to make sure we're putting you and that as the agent and your client forward with a potential contract that we know we can close. And it's so much different than years ago where it was just all verbal. And there probably are some loan officers out there who will write a letter that is not worth the paper it's written on. Like we have a really strong reputation for making sure that we're setting everyone's expectations correctly and giving everyone confidence that it's a good contract that can go to closing. So I think being prepared is so helpful, and all the time. It's preliminary. Like, we know. Yeah. Sometimes you close next month, sometimes you close in 2 years. But we are here for the long term. We're not going anywhere. We're here through the beginning. And oftentimes we'll have people pop up that started an application and didn't finish the application, and they need something done immediately. And we're finding ourselves working 7 days a week, but
it's normal in all of our industry.
Right?
Yeah.
It's hard when they started the application but didn't finish it. Right? Like, if you just finish it now, we'll be ready, whether you get this house or the next.
Right.
So it's the same amount of information needed either way. So doing it up front is a lot easier for us.
And it doesn't cost anybody anything to go through that process with you, and you won't be upset if they're not ready to buy a house in the next couple of weeks.
Yes.
Because I do think that maybe people feel like, oh, I don't want to waste your time, or I'm not
Not
ready.
at all. It's
You don't
better
have
to
to-
plan up front,
Yeah.
be prepared, definitely.
You do not have to apologize. So,
Okay.
and it is a journey. Sometimes it's like, no, price shock, not comfortable there. I'm going to wait and see what happens. Or, oh, I can go higher. I could go lower. I need to reroute. Like, we want to be part of that journey.
Well, that's awesome.
I had actually, they were colleagues of yours that settled on a property last year, and after the happy buyers got their first house, went to settlement, they were like, wow, we've been working with them for a year and a half. And I went back and I said, oh, their first application was in 2018.
Wow.
Years and
Wow.
years.
Yeah. Well, I think that's an important point for people to understand, is I think that you guys as mortgage professionals and myself as a realtor, that we do understand that sometimes it is a long time. You know?
And that's fine.
Yeah.
Very normal.
And we'll get there. Yeah. So can you talk just briefly about, like, what is pre-approval versus pre-qualifying for a mortgage? Because I think both terms get tossed around, and just want to clarify what they
Yes,
mean.
that's actually a question from my CE class. I usually ask the class that.
Okay.
Who knows the difference between a
And do they know?
pre-approval and a pre-qualification? Well, no, because there is really no standard definition for either term.
Okay.
You're going to hear regionally or company to company different terms used. The last couple of years of a very competitive real estate market, we hear pre-approval, we don't hear pre-qualification. And when I ask that question in class, and it's a continuing education class for realtors, when I ask the question, I'll have people say, well, pre-qualification means the credit wasn't pulled. Pre-approval means that they pulled credit. Or pre-qualification is credit, but no documents. Pre-approval is with documents. There really is not a standard definition, and it's going to vary company to company and regionally as well. For us in our marketplace, we define a pre-approval as, basically a full application minus the property sales price settlement date. So we do pull a credit report. I mentioned the soft credit pull. We pull that up front. Everybody fills out the same uniform standard or uniform residential loan application. It's the same application for every mortgage in the country. That's answering the questions in the government declarations. We pull a soft credit report, and we do request income and asset documents up front, driver's licenses, possibly visa, and that can vary borrower to borrower. So we are looking for 2 years work history with documentation, 2 years housing history, where do they live, whether it's rent or they own a property or not, and then 2 months worth of asset statements. And I frequently have clients or customers that object. Well, the other guy didn't ask me for my W-2 from 2022, and the other guy didn't ask me for my tax return. The other guy didn't ask me for this, or the other girl didn't ask me for this, didn't ask me for that. And I'm like, you know what? That's great. I know they didn't, and that's common. The reason we do it is really twofold. One, we want to be able to tell you 100%, we can give you this mortgage. You're going to get this mortgage day one at the pre-approval time. You're going to get a mortgage. And I will show you the options. That's the next step. And number two, we're in a very competitive marketplace. Northern Virginia, DC metro area is really competitive. Multiple contracts have been going on for how many years now? A long time, a long time. And it's not uncommon for a buyer to write a contract and hear, oh, there are 5 contracts, 7 contracts, 10 contracts, whatever it is. So we like to be 100% fully upfront with the pre-approval, so that part of what we can deliver is when you write a contract with a buyer, one of the first things I do is call the listing agent. And I tell my clients all the time, I don't tell them how much money you make, I don't tell them your credit score, I don't tell them how much money you have in the bank. What I do tell them is I've got full Fannie Mae, Freddie Mac, AUS approval, automated underwriting services approval. We've run credit, and good credit, I'll say credit's excellent. I'll mention the debt to income, percentage of the payment and liabilities to their gross monthly income. I'll say DTI is sub 35. I'll paint a picture for the listing agent so the listing agent feels comfortable, and the listing agent then goes to the seller and says, I'm comfortable with this one. It's with Atlantic Coast. They do a full pre-approval. The loan officer has checked everything out. I asked if it was self-employed. I'll say it's W-2 employee or it's self-employed, and we've gone through tax returns, it's been to an underwriter. I will give them basically the rundown of the loan up front. So we ask for a lot up front so that we can assure this consumer you're going to get a mortgage, and also we can help you win that house with the contract. That's the big thing.
I think it's so important that they're invested up front, because nobody wants to have a difficult situation when they're already under contract and movers are already planned. And we get a lot of rescue deals where people are like, the lender didn't follow through, we need help, can you all fix it?
Well, and that's not uncommon, and all of our colleagues will say that. It's not uncommon, and it's no knock against banks and credit unions and online lenders, but a lot of them are call centers.
Right.
So you have a loan officer that's working on a call center line, and they're collecting the minimum required docs, if any, for the pre-approval letter. They're sending it out and then wait and see what happens, and we don't do that.
Well, I mean, we're with USAA, but we would never use them for a home loan. You want to.
USAA is a great institution. USAA is a great institution.
But you want to go to your local experts who have your best interest and want to protect their agent, want to protect their business and their community. And right now it matters that you're answering after hours or Saturday or Sunday, that you're available.
Right. And when a seller goes to evaluate offers, an offer is going to be stronger when it's often a local, well-known quantity of a lender that they know when Tom or Samantha say that this person is solid and they're going to get a mortgage, that is a deal that's highly likely to go through. And that's important.
I think I said that in one of my weekly updates in the last week or two. I mean, I think we have 4 ratified for the month. 3 of them are first-time buyers, and 2 of them are 3% down first-time buyers, which I so disagree with this, but a lot of the real estate community, when they see a low down payment, they think, oh, no, it's a good loan. It's been fully vetted up front. It is solid. It's going to go to settlement. And I can convey that to the agents.
Okay, that's great. All right, so now I need you to get out your crystal ball and tell us, where do you think rates are going in the next 6 months, in the next 12 months? Or maybe the bigger question, maybe I think Samantha might say, it doesn't matter. But I think the people want to know, what do you think is going to happen?
I think they're going up.
I disagree.
Husband and wife.
And
yes, we work together.
Now let's
Should we make a bet on
Let's
that?
go back.
Oh, that would be fun.
Let's go back to late last year, early part of this year. All of the experts, Mortgage Bankers Association economists, NAR, everyone predicted that by this time this year, 3rd and 4th quarter, rates would have been slipping back down into the 5s. Are they going to get, sorry, any millennials listening, they're not going to get to 3% again. It's never going to happen. That was 100% government intervention.
Well, you'd have to have COVID again.
We don't
have a pandemic if you want that, right? We don't
and
want
even
that.
then, I don't know.
We don't want a pandemic, and it probably wouldn't be repeated either if we did have another pandemic. But everyone predicted it, and it went the opposite way. So Samantha could be right, but now most experts are thinking that it'll be, 2nd, 3rd, 4th quarter of next year that we'll start to see things. And it's really it's inflation. It's a lot of it's tied to the government's intervention or reaction to inflation, the market's reaction to the government.
I've always found that if you wait to buy, the only thing that happens is regret. Like the best time to buy
Oh,
was
100%.
yesterday.
So the real answer to that question is who really cares what they're
Right.
going to be doing in 6 months or a year, because that's not now. And
Right.
we can't control it. Who cares?
Right.
The question is, do you want to buy a new home? Do you have a need to buy a new home? You know, is there something, is it a need? Is it a want? That's something that the homeowner, the consumer, the buyer has to think about. And then next comes the mortgage.
I've always thought, yesterday's the best day to buy. Today is the next best. Tomorrow is the next. Like, if you need to buy a home, great. I do think one of the things we're seeing is people feel like golden handcuffs, like they can't leave their home. And can you actually talk? Do you mind if I ask
Oh
a
my
question?
gosh, that'd be awesome,
Can you
yeah.
talk to why it actually could work to buy a home now? What happens with your net worth if you hold on to the home you have, rent it out, and buy another home?
Well, yeah, and that's easier to show than talk about, and that goes back to looking at numbers, because numbers don't lie. But if somebody's thinking, oh, I really want to move to downtown Leesburg, but I have a 3% mortgage on my house and I don't want to give that up, well then talk to Deb, talk to your agent about, hey, what if I rent this house out? Because I really want to go downtown, but I'm out here in wherever I am. What if I rent this one out? What can I get? And then let's start looking at, okay, what if you rent that house out, get your mortgage covered, however much, and then have 2 properties building equity, increasing your net worth. And that's
Right.
something that, you can talk about it, but it's easier to show.
Yeah.
And I'm always happy to do examples and show people, like, okay, if we hold on to this property and we assume,
Right.
3% appreciation, which is quite low in recent
Crazy,
years, but historically that's a good number to use. 4% is actually a little more accurate historically. But if we use 3% appreciation, we can look at, current home, what the mortgage is, value now, and then look in 5 years, okay, what if you keep that home, rent it out, so we're trying to wash the monies, the cost, what your net worth will be, the property appreciation on your current home, and if you then invest another home with 5%, 10%, 20, whatever the number is, what your property appreciation would be, and let's look at the net worth.
It comes out
equity net
so
worth.
much better
Huge.
to go buy another house now,
Huge.
right? Because
Yeah.
2 properties growing in value on the total value is just more money. So it actually is smart to move if you want to, right?
If you want to, it
But
comes down
we're
to
in a
that.
house that we don't want to move yet, but in the next 2, 3, 4 years, that could absolutely change.
You think?
right?
You think?
He has never wanted to move. I've had to make him make every move, and I've been right every time.
I'm glad I canceled the last one.
Oh, I don't remember what that was.
You remember coming back one day in like 2004, 2005 saying, I put a deposit down on a house?
Oh, okay, yes, you're right. Yeah, I'm glad we didn't get that one.
Yeah.
Well, and something that I hear a lot and see in print and hear experts talk about is in our area, in Northern Virginia and the DC area. I mean, almost every real estate investment is a good investment because
Historically,
properties,
it always
yeah.
has
Yeah.
been.
hold their value
Yeah.
and increase.
And there are
in
going to be
value.
ups and downs like
Yeah.
anything else. That's
Time
normal.
always fixes a down, but we really haven't seen many of those either. So generally, because we're in that little bubble, this is a pretty secure place to buy,
Right.
and a very popular place. They're showing the younger generations, the 20-someths, are really moving to the DC area. It's a more affordable area than other cities,
Right.
and a lot going on. So, and then of course we have. Between the politics and the job growth here, there's so many opportunities that have always just protected us.
Right.
And I always think every time we've ever bought a home or even refinanced, or when the house down the street sells, we're always like, this has got to be a high. It cannot get any higher. But we've been wrong every time. It's always gotten higher.
Uh-huh.
And I'm like, it's just money.
Yeah.
Just
Yeah.
money. We're handing it out every day with a good loan to
You have to qualify for it, but
Yes.
yeah.
So, is there anything else that you think would be helpful for people to know about the current market, about getting a mortgage at this time? Anything else you want to share?
Current market, getting a mortgage right now. I would say if you're thinking about it, get pre-approved. Number
Yeah.
one,
So
do
you
that.
know- so
Make
you know what
that
you've
make
been
that
doing.
number
Right.
one. Even if you're
Yeah.
just sitting at home scanning Zillow at night or whatever, get a pre-approval, get a real idea as to your qualifications, what it really looks like. I mean, actually, on the way I was coming back from the doctor's this afternoon, and I called an agent back that had texted me about a client that's moving from Utah back to Northern Virginia after 30 years away. And her questions to me were, well, what price range is he thinking? What is he looking at? I said, he really doesn't know. And I tried to pull it out of him when we had a Zoom call. I kept saying, give me some ideas to your payment comfort zone, how much you want to invest, everything. And he said, let me think about that. But it's an example of someone that's making future plans. And I'm just like, look, let's just go ahead and do the application. Let's figure out the numbers. Let me show you what it costs to buy a home today. And you may look at it and say, that's great, that's less than I was expecting, or that's more, or whatever, but let's figure it out. So even if you're considering it, number one, get a pre-approval. It doesn't cost anything, there's no obligation, and it will give you the real info versus Zillow's website or some abcmortgage.com's mortgage calculator that isn't figuring what real taxes are here and what it really costs to buy a home in this area.
Right, and don't have the advantage of, human beings who are going to really sit down with someone and
And
try to
walk
match
through
a
it.
product to people and can be creative.
I'm going to put a little plug in for our team. We have 6 team members that have about 100 years of real estate and mortgage experience. We're really lucky with the Tunador group to have an incredible wealth of knowledge. We have a product expert in Lori who helps define the loans. We have your expertise in helping to educate. We have the best closing program. Work for the best company, got the best team. 100 years, we also have a lot of real estate experience. So we can kind of empathize and relate to what's going on. So there's a lot of good options out there.
Yeah.
There's the reason this team is in the top 1% in the nation.
All right. Thank you. Well, thank you so much for having me to your home studio and for all this great information. I think it's going to be very helpful to a lot of people out there.
Well, thank you.
Yeah, thank you.
We've got the recording going in multiple different ways here. So thank you for your time. We appreciate it.
You're very welcome.